Hey everybody, welcome to Trading Capital's daily analysis video. I'm your head market analyst here. It is June 21st, kicking off the first day of the trading week. As it was a long weekend for the US markets, they were closed yesterday. So instead of it being a Monday, it is a Tuesday today. So lots to discuss. Essentially, the markets had a pretty strong broad market rally. The S&P was up 2.5% and the Nasdaq was up 2.37%. Overall, every single sector today was positive, with the big leading sector being energy, XLE. And if we remember from Friday, XLE actually had one of the biggest sell-offs in terms of analyzing the cross-sector price action. And essentially, it was a natural occurrence for the bounce to happen in XLE. And before let's just bring up the XLE chart so we can get a clear picture of what has transpired. So the XLE here, obviously if we flip to the daily chart here, you can see that you came right into these pivot support area and you had this massive 1, 2, 3, 4, 5, 6, 7, 8 days of sell side pressure. Essentially 1 week's worth of trading action wiped out 14 weeks. So that's a tremendous amount of sell pressure. I don't think that the selling in energy is done. I think due to global GDP shrinking across the board, it's certainly going to put a lot of pressure. Ultimately, you'll have a little bit of minor support here at the $70 level, but I do think you crack that and break through. I will be looking to accumulate a short position on XLE if we retrace a pierce of this 50-day moving average, potentially filling this gap. I will execute a short trade. And ultimately, with the price of oil, in my opinion, still has to head lower with economic GDP declining globally, and with the fact that China's keeping their zero COVID policy intact until at least 2023. That means a lockdown could occur, and when China is one of the largest consumers of energy, it will certainly put a tremendous amount of pressure on energy if they do a lockdown, but let alone just the actual macro side of artificial GDP growth over the last 20 years since they introduced QE and zero interest rate policies in the year 2000. So that should start to come to an end as we start to introduce QT. This is the first month of QT, so we'll have to monitor how much the Fed is actually successful at in terms of removing from the system this month. Ultimately, let's go back to the S&P 500. So it was a positive broad market rally. You can see you've gapped up and then you never looked back and you started pushing way higher. And now the interesting thing to note, look at this range we're now in. So if you remember this price action here, this was the Fed day where we had this whipsaw crazy price action. And then overall at the end of the Fed meeting, the markets were trending up and you closed over here. But then what happened was the Swiss bank surprised the markets with that interest rate hike and the markets fell drastically. So essentially we're now trading back in this range where we were Fed. The markets looked very healthy to trend higher at that point in time, considering this was a bullish move up, breakout of this channel. Now it looks like you've broken out of this downsloping channel again, back into this consolidation range, and it does favor a move to the upside. Initially, you'll have some resistance up here. This will be your first intraday gap fill. But if we flip to the daily chart, let's just take a look at the daily S&P 500. Notice how this will be your first daily gap fill up here around the 377, 378 mark, give or take. But you did have a pretty good rally today with a gap up. So the fact that you gapped up today does leave the markets vulnerable for a potential grind lower to fill that gap and then potentially a rally. However, since we are in a clear downtrend, there is still a favored upside in the short term due to the oversold nature and essentially that we have got some clarity. Now, the interesting thing that I'm going to watch is if we retrace back to this parallel channel. So I think we do get a retrace back to this 386, 387 level, or just by the just on the outside of this channel, in and around that range. You do have a gap fill here at the 388 mark, so that'll be interesting to note if that coincides with a retrace back to the inside of this parallel channel that we were trading in before the sharper degree of decline took hold. And the interesting thing to note, if you look at the QQQ's parallel channel, its first initial one, we actually got the retrace back to the channel today, and you pulled off. So it is showing that the S&P is lagging. I think the S&P is lagging just as of late because of the fact that energies took such a massive hit on Friday and the week preceding. So interesting to note that the Qs did retrace back to their daily channel, and the SPY has not. So roughly the SPY would need to rally another 2 to 3% to retrace, basically 3.5% to the gap fill. So I do think there is potentially that upside to this 388 mark, and then we'll just have to reassess from that point in time. Congratulations on the massive win today. Let's just pull up the Carvana chart just to really take this in. I mean, we've played this now 3 times in the last 3 weeks, and we've profited double-digit gains on all of the trades. So amazing job if you've taken all 3 of those trades with me. But simply this round of Carvana, we netted a 23.24% gain. You can see our average entry was here, 2170, and we just sold it today at the 2684 mark. So incredible job. Do I think Carvana still has more upside? Yes, but you can clearly see the reversal signal that you got today. A nasty reversal signal right underneath the short-term moving average. So I think that is a great pickup. In the event that we do trend lower and we somehow get a rebuy back at our 21.75 or even this $20.18 level, I will look to accumulate Carvana once again. But it's going to have to coincide with the markets continuing to catch a bid, because that's where these things are now at. They have to catch a bid as money flows into the S&P 500. So congrats on that double-digit win. Massive gain to start the week. That's how we like it. We also picked up a new trade today. We started accumulating another short on Enphase. Let me just go over Enphase with you. Enphase Energy, it's not an energy company, it's a semiconductor company. However, one of the reasons I'm shorting Enphase, and let me just take off all these moving averages. There's a whole lot going on right now that we don't really need to focus on the moving averages. But look at this wedge pattern that we're trading in. So this wedge pattern is now coming to a potential resistance points at this downsloping channel. And one of the reasons why I wanted to pick this stock up now, just inch my toe in accumulating position, is for the simple fact that you filled this beautiful technical gap fill. Now there's no more gap fills to the upside on this chart, which leaves on a technical basis the chart satisfied to trend lower. And since you are making a series of lower highs, 1, 2, 3, you had this double top resistance which coincided with this trend line. You failed to make a higher high compared to this high. So it does favor at least by the minimum move down to gap fill or even the low range of this channel, since you did hit this channel and you failed to break out of it. So we'll just have to monitor Enphase. And to go over Enphase from a fundamental standpoint, semiconductors will get hit. Semiconductors have been created, essentially the rush for semiconductors has really been created in the artificial squeeze over the last 20 years that the Fed has introduced its loose economic policy. But the fact that now semiconductors are entering a tightening cycle, and arguably if we flip to the monthly chart on Enphase, Enphase originally started here in 2012, so it hasn't gone through a true tightening cycle. You did have this tightening cycle in the years of 2015, 2016, 2017, where Powell was slowly trying to raise rates, and look what happened. You had a 96% drawdown. So that's the type of, and this was in a relatively stronger market. So now we're entering a tightening cycle where arguably Enphase has never been through, and you're trading near the all-time highs. So that is pretty astonishing to me. Notice how this was your trend, your average trend that you were trading in. You have a clear IPO over here, you have a high, you have a low, you pierce through this channel over here, but now you're trading above that QE channel, so it does argue a massive collapse could be in store for Enphase. It does support the overall weakening of the economy. and essentially we'll have to monitor how. It's very interesting to see how all these semiconductors will act in a QT cycle. But in my experience and my historical analysis, essentially anything tech in related does get hit, and it gets hit hard. This might just be a late mover to the party, but I do think it's very rare to find essentially a chart that is trading near the all-time highs, especially when it's tech related. Yes, they have strong earnings, but ultimately those earnings reports have been propped up by artificial liquidity. And when you look at the valuation of the company, it is trading at a 157 PE. That is just insanely overvalued in my opinion. And essentially when you look at when its valuation put a high in 2020, it was trading at 185 PE in 2020, then 179 PE in 2021. So you have two declining years there, and then your third year in 2022 is also yet a declining PE ratio, as along with other metrics like its valuation and size and revenue. But the fact that it started declining in 2020, despite the price action and share price, the fact that all these metrics started declining in 2020, continued the declining trend in 2021, those were your QE cycles. Now we're just entered a QT cycle, and it should decline fast and furious. So downside target at the minimum is coming. You'll find some support at this trend line. But due to the fact that you've bounced off of this orange trend line, which was your parallel zone that you traded in before the QE stimulus broke you out of it, due to the fact that you hit it once, twice, three times, the fourth hit of this trend line isn't going to prove that it's not going to be as strong as people think. So I do think we get that inevitable sell. And essentially you still have this beautiful topping tail in effect, holding the price action in check. One could argue you are making a series of higher lows, but that's the beautiful thing about a wedge pattern, especially a wedge pattern trading at the all-time highs, entering a QT pattern, is that it does favor a move to the downside, a break to the downside. So let's just accumulate that name if it goes higher. We did add a little bit more to our LI short, as that chart is ridiculously extended. We could have added a lot higher today into this double kind of top area, but it wasn't my third resistance. Our third resistance had priced in around 38, and then eventually the real double top at 47. But if we flip to it on a weekly basis, this is another name that eventually will have a massive drawdown, in my opinion, a correction at the minimum to this gap fill. And one of the reasons being is, yes, it is a Chinese automaker, but at the same time, liquidity is going to evaporate faster than people think in this market, and I still think there's at least another 50% of the way in terms of fulfilling the downside on the S&P 500, which will ultimately drag many of these stocks away. But look at this. You've had a 1, 2, 3, 4, 5, 6 weeks of straight continuous weekly upside. That is true. 7 weeks of straight continuous upside. That is truly tremendous, but notice how you're into this massive resistance candle. Now, it'll be interesting to note, if you look at this move here, you had 1, 2, 3, 4, 5, 6, 7, 8 weeks of continuous upside. Here you're on your 7th week, but you're into resistance as usual. We should see some sort of a mean reversion pullback now that we are on that time count status. If we take a look at natural gas is just essentially consolidating sideways. It is forming, in my opinion, a little bit of a bear flag, but ultimately we want to see the daily chart. What does that entail for natural gas? Let me just remove this trend line over here. So the interesting thing about natural gas is I think you're just getting this oversold bounce. You did have a bear flag breakdown here. If you measure this bear flag, it does take you down to the 620 or 587, in and around that range. So I do think more downside is likely for natural gas, especially since forecasts for the natural gas consumptions have now dropped, along with declining GDP, along with the LNG terminal being shut in Texas. This is inevitably going to allow the reserves to build and build a lot faster than the market anticipated. So ultimately, I do favor another move down. The beautiful thing about natural gas's price action today is you had this initial move down, you reversed it, you rallied up to the gap fill, filled that gap perfectly, and then you pulled off. And that's why I want to flip to the intraday, because the beautiful thing about this, in my opinion, is you filled this gap and you had an immediate reversal on the hourly chart, and you put in this intraday topping tail candle formation. So that's going to be the candle to beat. Essentially, you do have a larger intraday topping candle at this point, which you have, even though you did close above it, you have not confirmed above this original topping tail. So not only do you have one intraday topping tail at the time that is still technically in effect because you have not confirmed above it, but you have now a second candle. So this is why I am leaning towards the fact that natural gas does have more downside. You have now the fundamentals taking control of natural gas's price along with the technicals, and we'll just have to monitor that from the time being. If you take a look at the UNG as well had that initial bounce, filled the gap, and now you've pulled off. So I really want to see UNG come down to this $20 level. I do think, since you haven't had a tremendous bounce like you saw over here and like you saw over here, I think the steam in terms of the bulls are running out of steam in terms of the natural gas price. And simply, if we look at the daily chart over here, the 650 area, which is key support, you had this massive move off of support over here. You had this massive move off support over here, and look how faded this move was. You basically had an initial pop, but have faded off of the highs. So that is kind of displaying to me that there's more sellers and less buyers flooding into this trade now. If we look at the US WTI chart, US oil, the WTI chart was down, but the USO chart was up. Notice how you are hitting this support zone over here where you pivot high, pivot high, pivot high, all your breakout above. I do think you get a little bit of bearish consolidation before breaking lower to the bottom of this range. If you take a look at the USO chart, it's very similar in nature in the sense that you had your breakout, now you've had your retrace back to the what they call the scene of the crime or original breakout zone. And the question is will we hold this level or will we start to break lower? If you break lower from this wedge, then I do think ultimately you're coming down to test the 68 area over the coming weeks. So we'll just have to monitor the price action of oil and see how that unfolds. Let's just take a look at something I want to touch base on, and maybe other members can start exploring and looking at data, but Japanese market, I am looking to short Japanese debt, Japanese bonds. And the reason being is the Bank of Japan is like the economic petri dish for the G7 countries. And what I mean by that is they're the ones that have implemented QE to infinity as well as negative interest rates. So whenever you have negative interest rates, as history shows that things lead to an inevitable collapse. And I do think, despite them being the third largest economy in the world, roughly 5 trillion, their debt to GDP is roughly around 262% when I last checked. And with declining GDP globally as we enter in a recession, it will really put a lot more strain on the Japanese economy as they have a declining GDP and as they want to suppress the yields at the 0.25 mark. So the Japanese central bank has already expressed that they're going to do whatever it's necessary to suppress yields at the 0.25% mark. And just today, we had this massive move in Japanese yields, an 83% move to the upside before the price action reversed. And when yields pop 83%, it means Japanese bondholders lost 83% if they sold here. Now, it did reverse because the central banks did come in and save their bond market by printing exceptional amounts of money. However, I do believe that they're eventually going to lose control of the yield curve, essentially with a declining GDP and the fact that they have to print more and more money every month to suppress these yields from shooting up. It's going to lead to a super inflationary collapse. Their economy's been in a deflationary spiral for the last couple decades, but I do think inevitably they're wishing for inflation and they're trying to create inflation, but I think they're going to get a lot more than what they expected, which is inevitably going to crush their fixed income market and really destroy and cause some sort of a credit crisis in their country. So I'm looking at shorting Japanese debt just as an FYI. I still have a bit more research to do, but I'll keep you in the loop as we progress. And I do think if the Japanese economy falls, then you'll see Italy, then you'll see Germany and the rest of the Eurozone completely implode. before there are massive bailouts and money supply expansions created to try to numb the pain of this economic fallout. But it's very interesting price action all the way around. Favorite in the short term, more upside in the spiders. There is that odd chance that we can pull back to fill that intraday gap. But since I am liking that you're back in this original bullish consolidation channel, and we'll just have to monitor it by day. So stay tuned for more action. Thank you again for being subscribers. Great start to the week with a profit in our pocket, and we'll look to continue to take profits on trades if we move into the money significantly. Notice I'm not shy about pulling trades off of the table, and hopefully we can continue to pull more winners off the table. That's it for now. Take care. Give this video a like or a comment down below. It'll be greatly appreciated.